Something unusual is happening in the global financial system. Silver has crossed $67 an ounce, a level many experts once believed was impossible without a major crisis. This is not just a price move, it is a signal. Behind the scenes, reports of large-scale silver leasing by major financial institutions have raised serious questions about supply, market stability, and trust. Tonight we are not here to hype, we are here to understand what is happening, why it matters, and what history can teach us about moments like this. Silver has always occupied a unique position in human civilization because it functions in two worlds at once. For thousands of years, it served as a form of money, a store of value trusted across empires, trade routes, and generations. Long before modern banking systems existed, silver coins facilitated commerce, settled debts, and anchored economic confidence. That historical role still matters today, not as nostalgia, but as a reminder that silver's value is rooted in tangible utility rather than abstract belief. In the modern era, silver's importance has expanded rather than diminished. It is one of the most versatile industrial materials in the global economy. Silver is essential for electronics, where its unmatched conductivity supports everything from smartphones to data centers. It plays a critical role in renewable energy, particularly in solar panels, where rising global demand has created structural pressure on supply. Medical technology, water purification systems, and advanced manufacturing also rely heavily on silver's unique physical properties. What makes silver especially sensitive is that these industrial uses consume the metal permanently. Unlike gold, which is often recycled and stored, much of the silver used in industry is lost or becomes uneconomical to recover. This creates a slow but persistent tightening of available supply. When financial demand and industrial demand rise together, the market has little flexibility. The result is a metal that quietly absorbs global economic stress until a breaking point forces prices to adjust. In a stable market, silver prices are expected to reflect a simple balance between how much metal is available and how much is needed. When mines produce more silver or demand weakens, prices tend to soften. When supply tightens or demand increases, prices rise. This basic logic still applies, but modern financial markets have added layers that often obscure this relationship from public view. Today, most silver trading does not involve the physical metal at all. Instead, it takes place through futures contracts and other financial instruments that represent claims on silver rather than ownership of it. These paper contracts allow large volumes of silver to be traded quickly and cheaply, providing liquidity to the market. In theory, they help stabilize prices by matching buyers and sellers efficiently. The system depends entirely on confidence. Every contract assumes that real silver exists somewhere and can be delivered if required. As long as only a small percentage of participants ask for physical delivery, the structure holds. Problems emerge when demand for actual metal increases, or when inventories shrink faster than expected. At that point, paper promises begin to lose credibility. Prices no longer reflect just supply and demand, but also fear, urgency, and uncertainty. When trust weakens, markets tend to reprice abruptly, revealing tensions that had been hidden beneath years of seemingly orderly trading. The move beyond $67 carries significance not because it is a round number, but because it represents the failure of long-standing expectations. For years, silver traded within a narrow range despite inflation, rising production costs, and steadily increasing industrial demand. This created a sense of stability that many market participants came to rely on, assuming that prices would remain contained regardless of broader economic pressures. When a market breaks through a level that has repeatedly held in the past, it forces a reassessment of risk. Traders and institutions that built strategies around lower prices are suddenly exposed. Positions that once appeared manageable begin to generate losses, not gradually, but at an accelerating pace. In silver markets, this is especially important because a significant share of trading is tied to promises to deliver metal at a future date. As prices rise rapidly, the cost of fulfilling those promises increases. Participants who sold silver they did not physically own must either secure metal at higher prices or close their positions at a loss. This dynamic creates a feedback loop. Rising prices force more buying, and more buying pushes prices higher still. What appears on the surface as a sudden price spike is often the result of years of pressure finally expressing itself. The breach of this level signals that the market is no longer responding to expectations, but to underlying physical and financial constraints that can no longer be ignored. A silver lease is often misunderstood because it resembles a sale on the surface, even though it functions very differently. In a lease arrangement, one party lends physical silver to another for a fixed period in exchange for a fee. The borrower typically sells that silver into the market, using the proceeds for financing or trading purposes, while committing to return an equivalent amount of silver at a later date. This structure relies on the assumption that silver will remain readily available when the time comes to repay the loan. Under normal conditions, leasing appears low risk, silver inventories are assumed to be sufficient, and price movements are expected to remain manageable. Problems arise when these assumptions begin to fail. If physical supply tightens or prices rise sharply, obtaining replacement silver becomes more difficult and more expensive. The borrower is then exposed to both market risk and delivery risk at the same time. What makes leasing particularly sensitive is its reliance on timing. The system works only if borrowed metal can be returned without disruption. When delays occur or when available inventories shrink, leasing arrangements amplify stress rather than absorb it. Small imbalances quickly become large ones, and what was once a routine financial tool starts to signal strain. In such environments, leasing activity can shift from being a neutral market function to an indicator that the system is operating closer to its limits than publicly acknowledged. The scale of a reported 4,000-ton silver lease immediately draws attention because it far exceeds what would be considered routine market activity. Annual global silver production is limited, and a volume of this size represents a significant share of what the market can realistically supply within a year. When such quantities are involved, the motivation is rarely convenience. It points instead to urgency, timing pressure, or the need to stabilize conditions that have begun to move out of control. Large leases tend to emerge when institutions face mounting obligations tied to previously issued contracts. If prices rise faster than anticipated, the cost of acquiring physical silver to meet those obligations increases sharply. Leasing becomes a temporary solution, allowing time to manage exposures or delay delivery commitments. However, this approach does not eliminate the underlying problem, it merely shifts it forward. Historically, moments of unusually large leasing activity have coincided with periods of stress in physical markets. Inventory levels decline, delivery timelines stretch, and confidence weakens. Market participants may not see these signals immediately, but they surface through price behavior and sudden volatility. When metal must be borrowed at scale to maintain the appearance of balance, it suggests that supply is no longer responding smoothly to demand. In such conditions, even small disruptions can trigger outsized reactions, revealing vulnerabilities that had been masked by years of stable pricing and financial engineering. Periods of stress in precious metal markets are rarely without historical precedent, and silver has repeatedly shown how fragile price controls can be when physical demand asserts itself. In the 20th century, governments and financial authorities attempted to manage metal prices through coordinated sales and market interventions. These efforts often succeeded for a time, creating the appearance of stability and abundance. Yet each episode ended the same way, once the underlying supply constraints became impossible to ignore. One of the clearest lessons comes from moments when official reserves were used to suppress prices. As long as physical metal flowed freely, confidence remained intact. But when industrial and investment demand accelerated simultaneously, reserves drained faster than anticipated. Paper claims multiplied, while real metal quietly disappeared into long-term holdings or industrial use. The gap between promises and reality widened. Silver has followed this pattern more than once. In previous cycles, prices remained subdued even as demand grew, reinforcing the belief that markets were under control. When that belief finally broke, adjustments were sudden and severe. Prices did not rise gradually, they reset. These episodes reveal a consistent truth. Financial structures can delay recognition of scarcity, but they cannot eliminate it. When the physical market reaches its limits, historical experience shows that price mechanisms reassert themselves decisively, often catching participants off guard after long periods of calm. Movements in silver markets often reflect deeper tensions within the broader financial system, rather than isolated commodity dynamics. Modern finance is built on layers of leverage, contracts, and assumptions about liquidity. These structures function smoothly when assets are abundant and confidence is high. Stress emerges when scarcity appears in places where abundance was taken for granted, particularly in assets that underpin industrial activity and monetary trust. When silver prices rise rapidly, the impact extends beyond traders and investors. Institutions that rely on complex chains of contracts face rising costs and increased counterparty risk. Each obligation depends on another being honored, and when one link weakens, pressure spreads quickly. This interconnectedness means that what begins as a commodity issue can evolve into a broader confidence problem. Rising metal prices also influence behavior. Investors reassess exposure to paper assets, while industries dependent on physical inputs face higher operating costs. Policymakers, in turn, are forced to respond to signals of stress that cannot be addressed through conventional monetary tools alone. Silver's behavior becomes a messenger rather than the message itself. It reflects growing unease about supply reliability, inflation, and the durability of financial promises. In this sense, the market response is not driven by speculation alone, but by a reassessment of risk across the system. Such moments reveal how closely material resources and financial confidence remain linked, even in a digital and highly financialized global economy. Periods of rapid change tend to expose signals that are easy to overlook during calmer times, and silver markets are no exception. One of the most telling indicators lies in physical inventory levels, particularly in major exchanges and storage facilities. When reported stocks decline consistently, it suggests that demand is being met by drawing down existing supplies rather than by new production. This is often an early sign of imbalance that precedes visible price stress. Another important signal comes from leasing and borrowing costs. Rising lease rates indicate that access to physical metal is becoming more difficult, even for large institutions. Delivery delays and changes in contract settlement behavior also warrant attention, as they reflect the market's ability or inability to meet obligations smoothly. These developments rarely occur in isolation. They tend to reinforce one another. Industrial demand provides further context. Growth in sectors such as renewable energy and electronics places steady pressure on silver consumption, independent of financial speculation. When this demand persists during periods of market volatility, it limits the system's capacity to adjust through reduced usage. Policy responses and central bank communications can also offer clues, particularly when they acknowledge supply disruptions or inflationary pressures tied to commodities. Taken together, these elements form a clearer picture than price movements alone. They help distinguish temporary fluctuations from structural shifts that reshape markets over time, often well before broader recognition sets in. Silver crossing $67 is not an accident. It reflects years of pressure building beneath the surface. Large-scale leasing raises legitimate questions about supply and market structure. History shows that when physical reality asserts itself, markets reprice quickly. This is not financial advice. It is an invitation to pay attention. If you value calm, fact-based analysis of global markets, like the video, share your thoughts in the comments, and subscribe for future breakdowns. Because understanding markets is not about prediction, it's about preparation.